Going to do another video lecture in our video lecture series on the Government Intervention Unit. This is a new unit, and we'll be looking at ways that the government intervenes to improve the economy. And primarily the way that they do that is through taxes, subsidies, and price controls. And we'll be going over each one of these in detail. So each video will cover one topic, either a tax, a subsidy, or price control. As you can kind of see in the examples below, that generally we hope that the government is there to help the economy, that everybody in it is working for its success, but the government is, some people see it as an actor that helps to improve things as well. Also, you can kind of see in the other right-hand caption there, Obama trying to, create private sector jobs. Sometimes the government wants to create jobs or improve a number of conditions in the economy, and so they seek to intervene to improve things. All right, let's get into it. Let's look at the learning goals. These are the learning goals for all three videos. So keep in mind that as we stop, the learning goals will sort of stated in this video are the ones for all three. First, we're going to need to know about what's called indirect taxes, and we're going to need to know about those two different types of indirect taxes. One's called a flat tax or a specific tax, and the other's called an ad valorem tax, and we'll talk about that. You'll also need to know about how taxes impact on consumers, producers, and the government. You'll also, kind of the opposite of taxes, need to define a subsidy, diagram a subsidy, look at how it impacts the market, and look at how it impacts different groups, and look at the consequences of subsidies. Finally, we'll look at why governments use price ceilings and price floors. You'll need to be able to create diagrams for both of those, and you'll need to look at the consequences for price ceilings and price floors. All right, so this first lesson will really be on taxes. Let's talk about taxes, everybody's favorite topic, right? The two things in life that we can always count on are death and taxes. All right, so first of all, direct taxation is when the government takes directly money out of your paycheck, or directly takes money out of your paycheck. So an example of a direct tax is an income tax. The government takes it from you directly, whereas an indirect tax is where the government usually takes the money away from you via a third party. It doesn't directly take it from you. Someone else takes it from you for the government. And the best example or best way to think of this is taxes on expenditure. When you spend money on a good or a service, or on goods and services, the government will place a tax on that, and the people that sell those goods and services give that money to the government. So that's kind of the reason why it's indirect. It's not that the government takes money from you, it takes money from companies that sell you things, so it's kind of indirectly taking the money from you. So there's one type called a specific tax or a flat rate tax, and that is basically a per unit tax. So when the government says we're going to increase the price of a good by $2, and we're going to have a per unit fee for every single one that they sell, it's now going to be $2 more expensive. It's called a flat tax or a specific tax, and it's a form of indirect taxation. The other form is called an ad valorem tax, and some people call this a value-added tax. And basically, this is also this is kind of a sales tax, or in Germany we call it a Mehrwertsteuer. And kind of what the government does is they put a tax on all goods and services that we buy, and so that when we purchase different goods or services, in Germany we don't see this because it's already hidden in the price, but there's a 19% sales tax on everything that you buy in any store or online website or whatever where you buy goods and services. 20% of that price is a tax. So just note that indirect taxes are kind of like sales taxes. And so a sales tax, whether that's a per unit tax on something specific like cigarettes, or if it's a general sales tax on everything, like an ad valorem tax. Just note that a specific tax is a flat tax, a dollar amount per unit or euro amount per unit, whereas an ad valorem tax is a percentage tax. Again, it's applied as a percentage. Please note, everybody seems to get this wrong. They think, oh, the government puts a tax on consumption, a tax on expenditure, and they think, well, that's going to impact consumers because, it's on what consumers are buying. It's not. Don't think of it that way. It's not a tax on consumers. Technically, consumers do pay the tax, but we need to remember that this impacts supply and not demand. And we'll talk about why. It is because firms view those taxes as kind of an impact on production costs. So, a business, for example, a good way that I like to think about this is like a retailer, like a grocery store. Right now, a grocery store will sell all sorts of different items, some of which are subject to tax and some are not. Maybe the government decides to put a tax on junk food, let's say, and every bag of potato chips, every candy bar, every sugary thing or thing with trans fatty acids is now more expensive. So you've got this junk food that's now more expensive. The person that owns that grocery store will look at it at sort of from a business perspective. I now have to pay more money when I sell these goods and services. So now my costs have gone up. I have to take money out of what I was using in operating my business, and now some of that's going to the government. So please remember that it's not supply or not demand but supply, that it impacts operating costs, and businesses now have to pay more money in order to operate their businesses. That's how they view it. So let's talk about a flat tax or a specific tax, a per unit tax. So here we can see, that something might cost $10 or $12 or euros on a supply curve, and we can see the units that would be purchased for each one. So at 10, it looks like 100 units would be purchased, and at 12, it looks like about 200 units would be purchased. If the government puts a flat tax on, that is going to create a parallel shift of the supply curve. It's going to shift parallel to the existing curve upwards by the amount of the tax. So, for example, if it's a $2 tax, that means that previously it used to be that a firm would sell 10 or 100 units at a price of 10. Now they're going to sell 12 at a price of 12. They're going to sell 100 units. So it's now going to be a higher price for that same amount of units. Also, you can kind of see above that at a price of 12, maybe they were selling 200 units, but now that at that price of 12, that's the old supply curve. The new supply curve, it's now 14 for 200 units. So you can see that again at 10 we used to sell 100, but now because of the tax it's 12 for 100. Again, and over here we see that same, so it's gone up at $2 at each given quantity. The supply curve is shifted up by the amount of the tax at each given quantity. Alright, so the next type of tax is called an ad valorem tax, and it's a percentage tax. And it's not parallel to the supply curve. It shifts in a way where it gets further and further in terms of distance from the supply curve as the price goes up. And to kind of give you an example of that, if you thought of a tax, a 20% tax on a good, right? So if something cost previously, and we'll look over here, something cost $5 and you put a 20% tax on it, what's 20% of 5? Well, it's 1. So that means that, if something costs $5, it now costs 6 based on that tax. However, if something used to cost 10 and you have that same 20% tax, it now costs 12. So the more expensive something is, the greater the tax burden or tax payment to the government will be. So that's kind of why the ad valorem or percentage tax will only get increasingly larger as the price goes up. All right, moving along. Please note that with taxes, as we just said, often when IB talks about taxes, they're often talking about flat taxes. So they may ask you about an ad valorem, but usually when you calculate a tax, it'll be a flat tax. So let's take an example here of, we'll say cigarettes, okay? The government is currently seeing that at a price of €4, 30 cigarettes are being sold at maybe your average store a day or something like that. Or maybe if we did it for the whole of Germany, it would be 30 million. But let's just say if this is just the market for one kiosk or something like that. At a price of 4, they were selling 30 packets of cigarettes. But the government decided they didn't want people to consume as many cigarettes, so they basically put a €2 tax on cigarettes. So in theory, that those 30 packs of cigarettes that used to be charged $4 or €4 rather now cost 6. But the important thing to remember with supply and demand is that they work together. And so, just how supply shifts, it's going to move along the demand curve. So it doesn't actually result in the cigarettes going up by €2 a piece, because now as the price goes up, people buy less cigarettes. And so this is going to result in a different price. And as you can see, the price goes up to €5, and it drops to 25 units consumed. And one thing to note too, and this would be a good example of something that's, why cigarettes would be a good example. If cigarettes, the old equilibrium price was 4 and it went up to 5, that's a 25% increase in price. So we've got a big increase in price, but quantity demanded dropped only by about 16% when you look at the drop from 30 packets to 25. So we can see a very small change in quantity compared to a larger change in price. So anyway, the new equilibrium price is 5 and the new equilibrium quantity is 25. And it's important to note that if you were to look at this diagram, it used to be that at €4 per pack, and a price of, that's the price, and the quantity is 30 packs. If you wanted to figure out the revenue for the whole market, you would basically times the number of packs times the price. So this equilibrium point shows us how to figure out the total revenue earned by the market. When this curve shifts to the left and creates a new equilibrium price, we've got a new amount of money earned by the market. We just have to remember some of that money is now being taken by the government. And so if you were to create a little line basically from the new equilibrium and draw it all the way down to the new equilibrium quantity, where it intersects with the old supply, make a dot there. And then if you draw that from that dot where you just made a parallel along the x-axis and make a line going from that dot that is parallel to the x-axis over to the y-axis, and then do that again with the old or the new equilibrium point up here, basically this box is an indication of how much the government is taking in terms of government revenue. This box here, so from basically 3 down to 0 and over to 25, would be the company's revenue. Both boxes together would be the total revenue. So let's go ahead and take a look and see what happens to markets when this happens. So we can see that, previously 30 units were sold of cigarettes and it was at $4 or €4. I don't have the euro sign on this American computer, so I guess it's dollars. That means that the business used to earn 120 euros, or dollars rather, on cigarettes. Now that the government's added that tax though, the new equilibrium is 5 and 25, so technically the market is earning more money now, and so it's now earning 125. However, we have to remember that the government is basically, of that price of 5, they're taking $2 out of that 5 for those 25 units. So if you look at the government tax times the quantity sold, the government revenue is 50. Also looking at that same, when you're looking at that diagram from the last page, and you looked at the rest of the money in the price, which would be 3, times that by the quantity, you can see that the firm is now earning 75. So of that 125 that the market's earning now, 50 is going to the government and 75 is going to the firm. So ultimately, it's not quite as desirable as we might think. So one thing to note about taxes, I don't know what that last slide was, it just popped in there. Why do we use taxes? Why do governments even want to put taxes on things? So let's go ahead and look at why they do that. One, governments want to earn money. They need money to run government programs or to pay for certain projects, like whether that's infrastructure, healthcare, or whatever. The governments need money to operate, so taxes are a great way to earn money. So that's one way that you can do it, is with indirect taxes. Another one, too, is that, as we just mentioned in that last example, often governments want people to not, purchase things that are harmful, that hurt society, and cause different burdens in different ways. So things like tobacco and alcohol. If you think about it, tobacco and alcohol create problems for society, and so if people consume too much of them, it's not good. And so, by putting a tax on tobacco and alcohol, it will make the price of tobacco and alcohol higher, and hopefully people will consume less of them. But they're both kind of addictive, so I don't know how well that works. We'll talk about that in a lot more depth later. Also, products that can be harmful to the environment. Some things like most fuels, like petroleum or gasoline or LPG or diesel, all these fuels are taxed by the government because they pollute the air, and so the government wants to discourage you from driving as much, and so they put pretty hefty taxes on fuel. Another reason why the government can use taxes is also to redistribute income. Things like luxury taxes. You put a special tax on yachts or on Ferraris or things that are really, really expensive. That way, people that have income to buy such exorbitantly expensive goods will then, have to pay more money, and then the government, it kind of levels the playing field a little bit. I don't know how well it works, but it depends on the amount of the luxury tax. But that is one other theory as to why governments would want to use a indirect tax. Finally, just a little bit more on taxes. One thing to remember is that it generally is not good for consumers. Now, consumers are paying higher prices. They don't like that, and they're getting less quantity for those higher prices. Generally, also, we say that sales tax is regressive, meaning that it hurts the income distribution, or basically the income inequality in a society. So generally, because everybody has to pay the same amount on a good, the wealthy can afford to pay a lot more in sales taxes than the poor. We'll talk a lot more about that when we get into macroeconomics, but just note that it can have a regressive impact on society because it reduces everybody's disposable income, and the poor have a lot less disposable income to get rid of. All right, also producers don't like taxes. Obviously, as you saw in the last example, the cigarette producer is now earning a lot less revenue. Also, it'll help impact their profitability, so it may lead to layoffs, meaning people that they just say, we can't afford to hire you anymore, we're losing too much money, and so that's kind of can be bad for the profitability of firms. It can also be bad for employment. Finally, the government's the big winner because they are intervening in the market, discouraging things that they don't want, and also increasing their own revenue. All right, so that is the video lesson on taxes. Thank you for watching.